Hey, hello. We're all very good and live. We're ready to go on another day here at the Selfwealth Live Technical Analysis edition here at Melbourne Cup Day here in Victoria. I know the rest of Australia doesn't have the public holiday, but I really wanted to get here for this show today, as there is a bit of movement in the markets, and we definitely want to have a look at that and hopefully have some other people on the other end of the line to be able to check out their tickers as well. Jace, how are you today?
Hey, Rog, I'm good. Looking forward to another show. I think we've got plenty to talk about as we usually do. We always seem to have plenty to talk about.
Yeah, there's always plenty to talk about. It's RBA rate decision day as well on Melbourne Cup Day. A lot happening. I think there's a big race up there in your way as well, called the Royal Randwick as well, from what I remember, something along those lines. So, but we're here for the markets for today, right? Don't worry about all the racing that's going on at the moment. So, welcome to everyone else on the other end of the line. If you are into the racing, hopefully you have a good win today during the carnival, obviously. But without further ado, let's get going, Jace, with the disclaimer to start off with. Thanks.
Yes, so just a quick note on that. Everything today, general commentary only, no personal advice in any of this. And I'll quickly pop up our disclaimer that goes up each week. That just goes through that. I'm also not part of Selfwealth. My business is Motion Trader, so my details are in the top section, licensing and all of this in there. And beneath there is a Selfwealth disclaimer. Again, licensing, general commentary, all of that stuff in that slide.
Fantastic. So if you are a new person here at the show, what we'll do is we'll go through the three major markets, which is the Australian market, the US market, and the Hong Kong and Chinese markets. When I say the three major markets, the one that we offer at Selfwealth, obviously this show is produced to you by Selfwealth, by Saif. And then Jason is our resident expert that's actually not part of Selfwealth by Saif, as he's already mentioned, but he is part of his service, which is Motion Trader, which is a fantastic service, which you can get all the links to down below. So feel free to like and subscribe if you are a new person. If you've been here many, many times, you know the drill, because after the three major markets, we also go through your tickers. So check out your tickers that you might put in there. Make sure you put in one or two. We'll generally go through the first one only, or depending on time, because we just want to gauge and try and get through as many people as possible. So once again, the aim is to get through at least one person before I draw a line on the stand in the comments. So make sure you look at the comments before I say that we won't be accepting any more tickers. All right. I think other than that, Jace, we are good to go. We did have a bit of a down day last Thursday. Let's get onto the ASX there, Jace. That's all right.
Right. Okay. So let's start off with our chart of the ASX 200. And look, as you say, Rog, some volatility has entered the picture. For the last couple of weeks, the ASX 200 had been doing a good job at holding on to its recent gains. So we had earlier on, there's a 50-day moving average. We had a strong rally off the 50-day moving average in mid-October, and then we had this shallow sideways consolidation. And as we often discuss, shallow consolidations are often a good sign because it shows the dip's being bought. But that all changed last Wednesday with a quick sell-off, and that was after the inflation numbers came out, and then expectations around rate cuts started to change. The question now is, does this impact the overall trend, and should we be looking at Wednesday's weakness as the start of maybe something bigger? And I think the answer to that is no. So far, all we have is a pullback towards the 50 and the 100-day moving averages. It doesn't alter the overall trend, which at this point it remains up. We still have those rising moving averages, so the 50 and the 100-day moving averages, they continue to move higher, and price is still it's still generally above the moving averages. Yes, it's dipped a bit below the 50, but the overall structure is mostly occurring above the moving averages. So that remains a bullish backdrop. I think what the pullback does signal is that we're likely to see more consolidation, maybe even a retest of the September low. And that could be all part of a big sideways consolidation from the August high. Often we get these structures and markets where we get a sell-off, we get a rally, and then we get a retest. And then from there, maybe the market could start making its way higher. So look, we never know the exact path the market's going to take, but yeah, more consolidation, maybe that retest of the September low, just back below the 100-day moving average. That could be what we're looking at. But I think the key point is that it appears to be what we have so far appears to be a corrective move within an ongoing bull market, not the start of a larger bearish phase. It's interesting to have a quick look at the financial index, so the ASX 200 financials. And this appeared to be breaking higher last week. We spoke about this last week. Prices had broken to a new high, and it looked like prices were lifting out of this 2-month trading range. But then that quickly failed on Wednesday, with prices coming back within the range. Sometimes a false break can be a bearish warning. But in this case, I think it's simply a market that's not ready to move higher. Prices are still clustering around the moving averages against the 50 and the 100-day moving averages. And look at the rising lows since July. There's this series of rising lows in place. So it seems to me that this is a sector that wants to move higher. That's what the buying pattern of these rising lows suggests. We'll probably see the financials consolidate further in the near term, but like the ASX 200, I think overall this is a bullish structure. Just quickly back on the ASX 200, I think this remains a case of staying with the overall trend and not starting to bet that something different is about to happen. As it stands, Rog, I think the trend here does remain up.
Yeah, no, it's great that you're confirming a lot of the things. Had I looked at this chart maybe a year ago, even, or even a couple of years ago, I'd been looking at this as already a double top and potentially a turnaround here, which it could be. We don't know, right? But rather than preempting this kind of double topped theory around technical analysis, I'm now looking at this a lot more in the way in which you would look at it, as in, yes, it's just a corrective phase of this ongoing uptrend at this point. We haven't really broken any sort of lows just yet, right? So there's nothing to be freaked out of too much. But I'm not thinking double top. This is how I would have been thinking a year or two ago, right? Classic technical analysis, double top. I don't think that way anymore. So one of these things that I've learned is that, hey, we just don't know based on too much history, but we know right now, nothing's really broken in the lower end or the lower. So rather than predicting these patterns too early, let's just see where it goes from here, right? And playing the sort of earlier.
Look, Rog, I think you make a really good point. I think a lot of people spend way too much time using technical analysis to try and pick the top and try and pick the low. And I've spent a lot of time in my earlier years trying to do exactly that. But the thing I've learned over time is that it's the incumbent trend, which should be our default position until we have good reason not to. And trying to predict tops is not good reason to jump off something that has been working. So rather than bet something's going to stop working, assume it remains the general flow of the market until that evidence appears to the contrary. And for me, that involves price getting down below the moving averages, and the moving averages start to roll over. It's like, you look at these earlier times. This is when prices below those moving averages. This is when I want to be the most cautious and conservative in managing risk. Whilst prices are above, I think we give the trend the benefit of the doubt rather than trying to second guess when it might end.
I think, exactly. You've just confirmed my point there fantastically. All right, let's have a look at those US markets then. They're a little bit more bullish still.
Yeah, S&P 500, it hit its 36th all-time high for the year just a few days ago, last week. In fact, there were 4 quick all-time highs in succession. So when you just look at this chart on its own, it all looks good. It's like rising moving averages, prices above the moving averages, and of course those all-time highs we just mentioned. And so far, this looks like a shallow pullback from the all-time high. So those are all bullish markers. But I think there are a few signs the S&P 500 and the NASDAQ, they might be just getting a little bit ahead of themselves. So yes, it's a bullish trend, and that's all good. So I want to stay with the bullish trend, but the big cap stocks now seem to be diverging from the broader market. I'll show you what I mean. So just take a mental snapshot of what we have here. Now let's jump over to the S&P 500 on an equal weight basis. And you can see the structure does change somewhat. Still bullish, but those all-time highs have now disappeared. So while the S&P 500 has been hitting those all-time highs, the equal weight has been pulling back. And on Monday, it retested the 100-day moving average, and also pretty close to that low from October. Now, as I say, the overall trend is still up, but there's just no momentum to this trend at the moment. Just look at this price action. The equal weight, it's been trading in this two-month sideways consolidation. It's just been tracking sideways into the moving averages. And it's not just the middle to lower tier S&P 500 stocks that are pulling back. This is happening across the market broadly. So let me show you an indicator, which I keep an eye on. This is showing the percentage of Russell 3000 stocks above their 100-day moving average. Now, the Russell 3000, not to be confused with the Russell 2000, which is the US small caps. The Russell 3000 encompasses most of the US market, including the big companies. So it's a broad measure of the US market. And this is showing the percentage of those stocks above their 100-day moving average. And what we can see here is that it's currently at 46%. 46% of stocks are above their 100-day MA. In other words, more than half of the market is below their 100-day moving average. And I think with so few stocks participating in the rally, I think the upside maybe it's limited in the near term. In fact, I think the odds are starting to swing towards maybe some consolidation in the S&P 500, in line with what we're seeing in the equal weight. I think that until we start to see some improvement in participation, we start to see this indicator start moving higher. Maybe treat the latest all-time highs just with a little bit of caution. So just coming back to the S&P 500. Like when I look at this chart in isolation, it does look like it's about to pop higher to a new all-time high. So, just to be clear, I'm not, as we spoke about before, I'm not trying to call tops. I'm not suggesting big reversals. The incumbent trend is up. That's all good. I think that anyone who does try picking tops, I think it's a low odds game. But I think the price action that we're seeing in the equal weight and the indicator, which I just showed you, I think maybe it's a reason just to be a little bit conservative around new purchases and possibly cutting back on some leverage. Maybe if there's leverage being used. I'm still long the S&P 500. I plan to stay that way until the structure gives me reason to do otherwise. But look, it's rarely one-way traffic, and we just don't want to be complacent, especially when we can see there's non-confirming things going on within other segments of the market.
Okay, fantastic. And what about that Hong Kong market?
Well, over to the Hang Seng, prices continue to stabilise around the 50-day moving average. And I think this is positive. This positive price action following, see back down here a couple of weeks ago, we had this strong rebound off the 100-day moving average. And now we're getting this consolidation just above the 50-day average. I think that's positive price action. There could be some more near-term consolidation, but the underlying trend here, it remains up. You've got these moving averages moving nicely. This remains an upward trend. Going over to the Chinese market, bit of a pullback in the last few days, and that follows a strong rally like the Hang Seng, strong rally off the 100-day moving average. Now we're getting the pullback, but the overall structure here still looks bullish. I think the key now is for prices to stabilise above the 50-day moving average, and then to see some sort of signs of the buying of the dip, and that would be through like if prices start to stabilise and just start to hold their ground at current levels. That's a sign that the bids are coming in to support the market. If prices can consolidate around this level, possibly for several weeks, they could then establish a new platform, like we saw during September. You get that sideways consolidation, or maybe a sideways and back to the moving averages. You get that sort of consolidation for a few weeks. Then that potentially creates the next platform prices to move higher from. So I think this is a bullish trend. I think it's still got plenty of upside potential.
Yeah, fantastic. And just looking at this chart here, and even if I look back at classical patterns back when I was learning all this, I look at this as kind of like a break and a retest. But I probably would have entered this a lot. I would have entered in this a lot earlier with considering that it's coming down to retest that support zone here. But now in my wiser days, I probably am listening to you a little bit more and waiting for a little bit more of a consolidation and building that base where we will see a bit of a some more higher lows form and a base form before getting that breakout, that secondary breakout. Because a lot of the times these turn out into a bit of a false break, right? So but I think that's something that I've learned a lot now over the years. That's good tips there, just to be a lot more patient around some of this price action and patterns. Now let's have a look at our first ticker then today, Jay. So we've got quite a few coming through already, and we're going to start off with one that's come through via email. So we'll start off with DRO. I'm sure everyone wants to hear about this one anyway. It's had a bit of a spike and a drop once again, hasn't it? So
volatile stock. Look, the trend here does remain up. And that's been the case. We've been discussing this one since way back when it was just crossing back over the moving averages, and a wide trailing stop would have made it possible to ride this entire trend up and still be in it with this pullback towards the 100-day moving average. If I was holding this stock, particularly from lower levels, I'd still be holding it. It's a motion trader stock. Motion trader's got a calculated stop loss for this stock based off its recent volatility. I'd be using that, and that stop, I don't know it offhand, but it's going to be below the 100-day moving average somewhere. I'd be, and that's what's been key to staying on this trend. So, we look back at these periods, which at the time with that, they were volatile pullbacks. Again, back to the moving averages after big runs higher. Wide trailing stops help see them off. And the same process that kept us back in August, I'd be doing the same now. Whether this one does establish a base and moves higher, well, we don't know. Maybe that was it. But I'd still give it a bit more time, see if it can stabilise. I don't want to buy it here. I don't particularly like how quickly it's come back. Often, we talk about that, when stocks have a strong run, they pull back. We want to see that buying support come in. They start to hold a lot of their gains while the moving averages catch up. This one's been a quick fall back to the moving averages. So there's a bit of a red flag with that, but I'd still give it the benefit of the doubt for now. But not looking at wanting to add to positions at this point. And if I was in it, bought at the highs with a bit of a FOMO rush, it's a stock I would have closed out before now, because that's you've got to manage your risk. You can't have initial stop losses that are just so big. That's why we try to avoid stocks which have just raced away and become stretched above their moving averages, because in the end, the gravity of the moving average, it eventually does pull things back in.
Mm-hmm. All right. And another one via emails. EOS, please.
This is also a defence orientated stock, and it's been a hot theme, and we've seen it in Drone Shield, we've seen it here, and we've seen the equally strong pullback to the moving averages. If I'm in back down at good levels, I'm still in there. I'm still using my wide trailing stop. Like we've spoken in past shows about when things do become so stretched and there's multiple 100% gains on the table, that sometimes it's worth considering scaling out of a position. So maybe someone who bought down at a $1.50 odd could have considered scaling out during this parabolic phase of the rally. But where things are now, look, if I had some, I'd be holding my current position. without doing the calculations, I'm probably looking at a trailing stop, maybe somewhere in the above $4. If it comes back to there, well, I'm still potentially up several 100%. That's great. I can take that. I don't want to buy any here. I want to see first it needs to stabilize around these moving averages and start showing signs of regaining momentum before I'd consider buying. But for now, it'd be a hold. But working out where having a clear thought process around where the exit point is going to be, because what I see people have done many times over the years is that some people are really good at staying on a trend. Some people are hopeless and they take profits with, they make 20% and they're out, and you miss all this. So some people are no good at staying on a trend. Some people are really good at staying on the trend, but they're not good at getting off it. So they ride it up, and then they ride it all the way back down. So what I'd definitely not want. I've seen this happen many times, where you get over the course of maybe a year or so, a stock like this can make its way all the way back down to where it began. Now, I'm not suggesting this is going to happen here, because, of course, I don't know. For all I know, it's going to go and make new highs. I just don't know. But this is where we're just having a plan in place so that we avoid this possibility, because this is where a lot of people, fall into the trap. They're great. They ride it up and they ride it down, and then there's a whole lot of disappointment when they're closing it out at a small loss after they'd had a 800% gain. So have that fixed plan in mind. What do we do if prices continue to ebb lower? I think there's got to be that line in the sand where we say, okay, enough's enough. I've got to close this one out. That's what I'd be doing with this. But at the moment, I could stay in there.
Yeah, and I think look, this once again, if you get out and you're preserving capital, at least you can get back in if if it turns around, right? But when you're all the way down the bottom, you've lost all that capital to be able to utilize a bigger position, right? So it's definitely having that exit plan is so much more important than having.
So just show you, Roger. I've just got a chart that comes to mind, which not dissimilar, different percentages, but I can just demonstrate that point I just made.
Maybe you can also. There's a question here around trailing stops and what the setting you use, Jay. So it says in one video ATR set to 30, another video set to 14 by default, but I don't think it's any of those really. So
No.
maybe if you just go over the trailing stop that you would normally use as well, right? That would be great.
So look at this one here. Here's it's a company called Lark Distilling. It doesn't really matter what the company is, but again, it's that big uplift in the share price from $1 to $5. I had this stock myself, so it comes to mind because I do remember it was a motion trader stock. I think where this arrow is, that's probably where I got out. I've probably used this as an example before. So this is probably where I got in. This is probably where I got out. And I wonder how many people held all the way down to eventually below where the breakout entry point was. So not saying EOS is going to do this. We don't know. But I've seen this profile so many times where you get the big move and then something happens and the story fades, and maybe this is over 1 to 2.5 years, the air completely comes out. It does happen. So that's why we want to have that exit point. Now, what I do, it's like Motion Trader's got a particular calculation, but it involves a 10 ATR multiple. So an ATR is the average true range, which is essentially a stock's trading range. So you get the average trading range over a period of time. Might be over the last month, for instance. So over the last, you get over a month, we might calculate what's the average trading range, and then we assign a multiple to that. So I use a multiple of 10, so it makes it a wide trading range. But of course, the wider the ranges, when you get periods like where there's big ranges, like there's like almost a $1 day there, and that's going to like beef up the average over that period. As the ranges get wider, the multiple of 10 gives you a wider trailing stop. So we can quickly put it on. Let me just put on This is not the Motion Trader exact stop, but it's a trading view stop, which will give an approximation. There you can see how it follows the share price up, eventually hits runs into the share price. There's your exit. It's calculated. You can see the settings I'm using in this. Where is it? Inputs. No, it's giving me for the moving average. This is the one I'm after here, I think. Okay, you can on TradingView interactive ATR, you can call up the settings and you can adjust your settings. For this particular one, this is not Motion Trader. This is just what I've got set up to use on TradingView. Motion Trader uses a multiplier of 10. I use a multiplier of 10. I've got 10 set up here. The length is using 14 days to calculate, so you can just change the settings. The key one is 10. It's a multiplier of 10 on the daily ATR, and that gives it that wide trailing stop, which gives it lots of room to move around. So I don't think there's any inconsistency in any videos I've done, but yeah, people might be hearing different numbers because there's different inputs. It's like just making sure you're listening to the right input, but the multiplier is a key one. It's 10 is what I use. 10 is not a special number. We could use 9, we could use 12, you could use 8. A lot of people want to use 4 and 5. It makes a tight stop. The stop then starts to track like maybe the 50-day moving average. It works on an explosive trend, but most trends aren't this powerful. So the closer the stop, the harder it is to stay on a big trend.
Yeah. Yep. All right. Fantastic. Good explanation. Thanks, Jace. Let's get on to Jennifer's FFM, a Motion Trader copper signal. Is it too late to buy this one?
Look, at the moment, I've been saying in the Friday strategy sessions, the copper stocks may need some time to consolidate. And this one may need some time to consolidate. It's a big run, probably getting a bit stretched above that moving average at the moment. I think I've actually got some of this myself. I hold quite a few stocks, so sometimes I'm not sure on code, but I think I've got this one. If I do, I'm certainly happy holding it because it's trending above the moving averages. Even though it's stretched, I'm not looking to take profit or do anything like that. I'd rather try and see off a potential consolidation, stay with the trend, not try and trade in and out. I want to try and capture the big moves, not little pieces of moves. And I think maybe the next consolidation could present the next opportunity to buy. But for now, I think I think this is one to hold if someone's in, one to watch if someone's not in. Like the thing is, like, where do you buy it now? You go, okay, this is all good. I'm just happy to buy it now. But where are we going to put our stop? Like, you probably got to have it back down here. You probably got to give it at least 26%, which is, look, maybe that could be done. But I'd just rather, not change, particularly also when the copper price itself seems to be in a bit of a consolidation at the moment. Maybe we get some consolidation here too.
Fantastic. Next one is sorry, from Remus. It's MSB.
We're pulling back towards the moving averages. It's the potential for this. I think this is a potential emerging trend. It's Mesoblast is notoriously volatile. It gaps up, it gaps down. It's been a difficult stock over the years. Really, these are. It's been a hard stock to make money on. It's not a nice, clean, trending stock. But at this point, like if I'd bought some, I'd bought some as though they were breaking higher. It's rallied a bit. Now it's come back. I'd still be content holding it for now. Initial stop loss back below the 100-day moving average. If it can stabilise here, if it starts to stabilise and move sideways and then starts to break higher again, a little bit like we saw during September or so, consolidate and then start to break higher, that could be another entry point. So consolidation, then another break, that could be an entry point. At the moment, I'd just I'd be okay holding it for now. Have an exit point in mind in case this pullback continues to gather steam. If it gets much below the 100-day moving average, I'd say, look, it's just getting a bit messy. I'd probably look to close it out. But for the moment, I think there's potential of an emerging trend. We've just got to see how the price action plays out over the next few weeks.
Yeah, fantastic. Next one's from Mick. Hi, Mick. It's WHC, please.
Yeah, potential emerging trend here. It's the copper, the coal stocks. The coal stocks have been, they had a great run during 21 and 22, and in the last 2.5 years or so, they've really all been pulling back and consolidating. But look, prices have gone from below the averages to above. We've consolidated sideways along the averages. We've got some rising low points, which is encouraging. Prices continually seem to be breaking to new highs. I think there's potential that this is an emerging trend. I think it's one that could be bought probably at current levels with maybe with like a 10% stop that just gets below this low point from when's that? Late October, back below the 50-day moving average. So 10 to 12% sort of region perhaps, and see whether this has been like a consolidation, which prices are now lifting out from, and then we see whether it runs. And it's like we're just looking for those asymmetric setups, and we just keep playing them and see which ones run, which ones come back. If it comes back, no problem. We take a relatively small loss. But if it happens to run and gain some momentum, there's nothing to say it can't exceed the all-time highs at some point in the months to come. So that's asymmetric, relatively small risk, oversized potential upside. So look, an interesting play.
Right, fantastic. Hi, JC. Let's have a look at PCK. Sorry.
I haven't seen this one before. Low price stock. Look, it's certainly not for me at the moment. It's a spiky type of stock. It's like it spikes, comes back, spikes, comes back, spikes, comes back, spikes, and what do we say? Comes back. It's sort of stock I'd leave alone. It's maybe something develops from it, but it's a really difficult one to play. There was some structure to play off back in July, August, so we had some consolidation around the average. So we had a bit of a breakout, shallow pullback. That all looked interesting, bit of a run, and then it took off with a spike, but then it quickly gave it all back. So it's not like it's a stock that's being accumulated in the pullbacks. It's a stock that's being unloaded on the rallies. So that's not what makes a trend. The trend's made by the buying of the pullbacks, not the selling of the rallies. So look, I'd have to leave this one alone. Again, it doesn't mean that it can't do something amazing, but the price action's just too hard for me to work with, unfortunately.
Okay, so nice saying there. A trend is made by the. I'm going to botch this up. A trend is made by the buying of the pullbacks and not the selling of the rallies. There you go. So write that one down in the notepads. Hi, Langel. Let's have a look at 4DX, please.
Yeah, plenty of volatility here. Look, nice upside volatility. But now we're getting the pullback to the averages. Not surprising. This is one of those occasions where if I'm in early and I get this and I'm up, what could that possibly be? If I'm up, 300+% in this sort of stock. One of those ones I'd consider maybe a little bit of a scale out. When I say scale out, it's just it's a fraction, whether it be a fifth, a quarter, a third, whatever it may be. Just taking the top off it, because we know when they go up so fast, they nearly always seem to come back and revisit the 50-day moving average. And then, as we saw in our last stock, some of them that spike up, they can quickly come back as well. So sometimes with these ones, it can be an idea to take something off the table. If I had this one now, I'd generally be holding a core position, particularly if I'm in at lower levels as prices start to break out, and see where this goes. Like this could take several months now to consolidate. Like I think probably the best case scenario would be like several months of consolidation, build a big platform, and then maybe into next year we start to see another move higher. Is it going to just spike up again? Well, the start at 25 cents to get to 250 and to continue to spike up, it's probably not going to happen. Anything can happen, but I think at best we're looking at months of consolidation. I don't want to buy it at this point. I want to see that, see it get a foothold around the moving averages, see it start to establish up some bit more of a new base, and then we can look at it then. But yeah, no problem with maintaining a core position. Trend is certainly up at the moment.
Okay, thank you. G'day, Adrian. Let's have a look at SPX.
SPX, this would be the one, would it? An ASX one? Because SPX is also a code for the S&P 500. So
SPX, so as long as it's ASX, yeah.
Presumably this one. Look, no, this is just a no. It's like, just look at our moving averages and look at our price. So the price has been persistently below the moving averages. 0.3 of a cent. It's like you'd have to question the ongoing viability of a company that gets down this low. Look, this is just too much risk, and it's like you take a position at 0.3 of a cent, and then it trades to 0.1 of a cent, which is only like a relatively small move on the chart, but you're down like 50, 60% in a tick. It's like it's too much risk, and people say, "Oh, well, look, it's only got to just get up to 0.6 of a cent. That's not too far, and I double my money." But I don't think we should think in terms of like how much we could make. Think about it in terms of how much you could lose first. And once you're comfortable with your downside, then you start to go, look, is that downside, is the upside potential worthy of that downside risk? And that's how we work out, like, is it an asymmetric opportunity? But at the moment, I think the risk around a stock like this is, or a structure generally like this, it's too high.
There's so many little truths which I listen to now, and I think I'm one of those people that used to go calculate the upside potential versus the downside risk, and I no longer do that. Right, I'm always looking at how much I'm potentially going to lose if it goes the wrong way, because the upside potential is you're never going to know that, and then if it ever does go to that point where you thought it was going to go to, then you'll say to yourself, you're right. But in my experience, I was wrong so many more times than what I was right calculating the upside potential versus my downside. So if there's anything you take away from these shows, it's definitely to start flipping the way you think a little bit. And it's not to be negative, but at the same time, calculating your upside, whilst it sounds good, it probably makes you enter positions not knowing the downside risk, right?
Yeah, look, we never know the upside. Like, so I always say the upside potential because we don't know. And it's just like I just look at the chart structure, and it's kind of like I'm doing a rough probability analysis in my head, and sort of going, well, this one is traveling below declining moving averages, so it's probably more likely that it's going to drop than rise, and so I'm going to I put a higher weighting on the incumbent trend, which is down. Whereas when we get a stock which, like this, has had some time above its moving averages, so if we look at this in a time like this, where it's consolidating sideways into rising moving averages, I say, look, we can manage out. We can buy this breakout. We can put a stop loss. We can calculate a stop loss. Maybe it's like 20% below. And could this stock double? It's a question I'll often ask myself. Could it double? Could it go from 4.5 to 8.5? It could. That doesn't mean it will. They're saying, it could. So I can say, look, I can risk 20% and it could double. So I've got 5 to 1 possible risk reward. So I'm just playing that sort of rough parameter every time, and that's I'm trying to put myself into a position to where I can potentially get some good moves. So most stocks won't double, but just knowing that there's a reasonable possibility that could happen. Whereas if I look at a stock now, which is below declining moving averages, what's the probability of it doubling? Well, that probability is much lower because it's in decline at the moment. So I'm kind of going against the trend. So it's like probably a bit of experience in doing it many times to sort of like get that feel for it. But using the overall structure, is it above? Is it below averages? Is it reasonable that it could go up a lot? Our loss is pretty much a fixed point. Markets can still gap below stops, of course, but it's probably our most fixed point. And taking it from there.
All right, fantastic. G'day, Neil. Let's have a look at KLS, please.
Yeah, trends up, rising moving averages, sideways consolidation. Like you can see, like we would have been had we been looking at this, we probably would have been saying, look, it's now getting a bit stretched. Maybe look at it on the next consolidation, see if it can hold on to its gains. These are common things we talk about, and then this one here, sideways consolidation. Let's let the moving averages catch up. It's now reconnected. So this is an interesting point. This is a possible buy the dip situation. I'd probably wait for a bit of a rally off and buy some momentum. But buying the dip into a sideways consolidation can often work out quite well. Is there an earlier example we can quickly see? Look. Yeah, well, look, I guess this is we could have bought this an early pullback to the moving averages based on the things I was kind of saying then, but it can take longer and it can get deeper. That's the risk of jumping in early. Whereas if we wait for some more momentum, get it to clear some previous highs, then we're kind of going with a bit of momentum. It can just help lower the risk of getting in too early. So this one here, look, maybe if we got a bit of a rally off the moving average, consolidate again, and then a break. I think there's probably a bit more structure we could look for. Although that said, if somebody was really keen, they could, buying it now probably needs at least 10% stop loss. Oh, look, an aggressive stock would just be below the recent low, but that's it's like 5%. But the broader market then consolidates for a couple of weeks, maybe that would then trigger. So it's playing it pretty tight, trying to do that. But look, if I had this stock, I'd be happy holding it. I'd be looking for an entry opportunity if I didn't have it and I was interested in buying it.
Okay, fantastic. Yep, the little goatee's gone for now, just while I support Movember there, men's mental health. But thanks, Astro. Thanks for noticing. And sorry, and the moustache replaces, obviously. Let's have a look at AGL. Thanks.
Still in a downtrend. It's retesting these moving averages. So is there a potential turn underway, or is it simply a case of rallying back to the averages and coming off again? It's too early to call the turnaround. This could just be like a rally back in the moving averages. Sell the rally and prices come off again. It's not a stock I'd have at the moment. It's not a motion trader stock. If it continues to trade sideways and then starts to break higher again, it starts to set up the situation where it could be an opportunity. But I just think it's a little bit early. It's sometimes it's hard to distinguish between just a bear market rally and the real thing, where you get the rally back to the moving averages and it comes off again. maybe there's something. There certainly could be something developing here, but I'd just prefer to give it a little bit more time.
Okay. Adrian, SPX. Okay, well, let's have a look at SPZ. We haven't looked at that one, have we? No, SPZ.
No.
So SPX is meant to be SPZ, but it was a good example, SPX, of what around.
So I've got some of this myself, and only just recently, bought up near current levels. It was, I was looking at going, well, because I had a single signal a couple of days ago to get in at around $1.20, and there was a motion trader signal at the same time, so I didn't buy in the same day, so I left it for a day. Then it's rallied a bit from there, and so it's now at a point where it's like, well, do I buy it now that it's a bit stretched, or do I wait for a consolidation? And I reasoned that, like, I'll wait for the consolidation. What will annoy me most if I don't buy it and it pops up again next week, and then it's like, well, now how am I going to get in? So I've decided to buy in around current levels. I think there's a reasonable chance this will consolidate, like we've seen before. We get the strong rally off the average, and we get the consolidation. I think that could happen again. That could create an entry opportunity, although, as I've just said, I bought at current levels, so it can probably be bought there too. And the risk is probably 20% back below the 50-day moving average. That's reasonable. It's trending higher. I like this consistent series of rising lows and rising highs and moving averages, and it's a stock which has been persistently trending higher for around 3 years, and it's just coming out of this. What would that be? That's almost like a 12-month holding pattern, maybe 10-month holding pattern. Trends up. See how much higher it goes. Would have much rather been holding a position from way back early on, but some of these trends can continue on for some time. So it's probably not my highest confidence sort of trade, but there's a trend there, and I'm on it.
Okay, fantastic. Let's look at the next one. CU6, please.
And I say not my highest confidence trade simply because of just where I got in. If I was holding SPZ from much lower levels, great. I'm very happy holding it. It's just not the greatest entry after something has trended a lot. But as we know, a stock can look like it's already trended a lot, and then it can trend a whole lot further. So it's just going with trends, going with momentum, and being prepared to be surprised on the upside. CU6, it's still a potential emerging trend. Had a strong rally off the averages a few weeks back. It's come back to the averages. What's good here is it's stabilising around or just above the 50-day moving average, so it keeps that bullish potential in play. It's like up on its highs for the day at the moment. Like one possibility would be to buy it at current levels and have a stop back below the 50-day moving average. It's around 20%, which is probably reasonable because it does look like we're getting that bit of a rebound off the averages. Or we could watch it for a little bit longer, see whether it can hold these gains and push higher again. I'd be happy holding this one if I was in from maybe a little bit lower. Would I buy it today? I could consider it if I wanted to get this stock. If I had a signal to buy it and I needed to buy it, I'd consider buying it at current levels, or I might just wait, see if it can make a new high above last week's high, just get a bit more momentum going, and then see whether it continues to evolve into a trend. It's certainly got the criteria for a trend in place. Let's see whether this one gains momentum or not.
Okay, fantastic. Next one, CBA.
Yeah, it's doing okay. It's a motion trader stock. It's been a motion trader stock for a long time. And the signal's back here in 2020. This is what a wide trailing stop can do. Wide trailing stop saw off a couple of years of consolidation, stayed on this big trend, stayed through a couple of pullbacks, collected dividends along the way, It's what a wide trailing stock can do. It can stay in a medium-term trend for 1 to 3 years. This one's even longer. This one's now approaching probably 4 years. If I was holding this one from lower levels, great. I'd be happy holding it still. It's maybe there's more consolidation in this. It's starting to turn higher. Maybe that's it. Maybe we've seen the low. It's back above the moving averages and starting to re-establish above the averages. Like we were looking at the financial index earlier, and that looks like it wants to. It's gearing up for another push higher. I'd probably hold off buying just yet and just see how this consolidation plays out. But if we start to get a break above these recent highs just from the last few weeks, maybe that would be the momentum to go with and see whether it continues to build. But yeah, very much happy holding if I'm already in.
Okay, fantastic. Let's look at the vendors. We're going over to America. We'll look at one IBM, please. It's probably IBM. Oh yeah, is that it? Yeah, IBM.
Yep,
Right?
that's IBM. It's a big upward trend is in play, has been for some time. Look, if I was in this one, I'd be holding it, particularly if I'm in from lower levels. Trends up, wide trailing stop would have been able to see off all of these pullbacks. I suspect it has a few brief excursions below the averages. That's fairly normal within uptrends, and hitting new highs. So I think the play here is just staying with it. Do I want to buy it at current levels? It's like, I don't know. I don't know how enthusiastic I am about buying it at current levels. Also, just going on what I was saying about, like, there's that bit of divergence in the US market. Look, if it can continue to, it's rallying off the averages, if it can continue to hold these gains maybe for a couple of weeks and the averages keep moving higher, well, then it probably is a buy at current levels. It scares people to buy a stock at an all-time high, but all-time highs aren't good predictors of tops. All-time highs are often predictors of more all-time highs. So I think the trend remains in place, and maybe this sets up as a buying opportunity if it can hold these gains over the next couple of weeks.
Okay, very good. I wish. Let's look at GNP, please.
Yeah, I've got some of this one. I've had it for quite a while, and the trend remains up. I'm happy holding it. Wide trailing stop. I've got the motion trader calculator stop, which is somewhere below the 100-day moving average. It's just recently broken out of a little consolidation. Look, I'm probably not a buy here. I prefer to buy just as stocks are rallying off the averages or breaking out of a consolidation. This one's had a big advance, and look, like I said with IBM, if it can hold these gains off the moving averages over the next couple of weeks, and we get a bit of a sideways consolidation, maybe that would be a buy. But I'm very, very happy holding it and just letting it run. That's what's been working for me, just letting it run. Being patient. Like, look at this period through here, through 2024, where it's just going sideways, trading sideways into the moving averages, not dissimilar to what the financial index is currently doing. But just being patient during these sideways consolidations which have occurred over time, and letting it run, not worrying about the multi-week pullbacks or multi-month consolidations, as long as it's staying comfortably above that trailing stop, and that remains what I continue to do.
Okay, fantastic. G'day, Headley. Let's have a look at KCN, please.
Yeah, trends up, strong rally off the moving averages. It's look, this has been a big trend which continues to deliver. It's up a lot in a relatively short space of time. So this would be, I'm pretty sure this is a motion trader stock and meets all the criteria. So the entry probably should have been around $1.60 odd. Oh, it's up 170%. Yeah. Look, I'd be happy staying with this one very much. Wide trailing stop. I'd use the motion trader calculator stop, of course, and it's just about whether we'd buy it at current levels. It's just made a new high, but it has been like a strong rally. Maybe it's going to like just have that pause and consolidate. What would be the risk? Like, I think, buying it, stop's got to be about 25%. You're really looking at getting below this low from bottom of October, end of October. I'd probably be more happy just holding it rather than buying it. But look, that said, buying a breakout to a new high, we can calculate a reasonable initial stop. It probably could be considered if somebody particularly likes it.
Okay, fantastic. Thank you. Let's have a look at VUL, please.
Yeah. This is definitely one I'd be hanging on to if I had it. Strong rally, pull back to the averages. It's now a case of like, are we going to see more of an ongoing consolidation? Like, it's had that initial rebound, but are we going to sort of see it like come back and retest, get more of a sideways movement before maybe like pushing higher towards the end of the year into next year? I just look at the proportions and look at the size of the rally. It's a fairly short pullback so far. I just wonder whether there's another retest of the of the October low, or maybe the moving average. Maybe we get something like that. Maybe we get something completely different. But that's kind of what I think when I look at this. I'm probably not in a hurry to buy it off this initial bounce, but I'd certainly be happy holding it if I'd bought it as it was starting to break out of this bullish wedge formation, get back above the averages, start to break higher. That's probably when the motion trader signal would have been. That's where I'd be happy holding it if I was in those good levels. Now I'd be watching it, and if we get that some sort of a consolidation structure that we can work with, maybe it becomes another buy. But just hold or watch for now.
Okay. Next one. Hey, James, DBI, please.
Sorry, what was that, Rog?
DBI.
Yeah, it's started to stabilise. So this has been a stock which has been in an upward trend for a long time. It's been a steady upward trend too. Perfect stock for a wide trailing stop. It just staying this whole uplift in the share price. And it does have these periodic pullbacks to moving averages, which we've seen now. I'd be holding this one. It's a motion trader stock. It's a motion trader stock. This pullback has been within the parameters for the trailing stop. Look, I'd just be holding it. Probably not a buyer at this point because we're just trading sideways along the averages. Who knows how long that could last for? I'd probably want to see some momentum start to develop if I was going to buy it. But one I'd be very happy hanging on to.
Okay, thank you. Next one is SKK. SKK.
Yeah, a low price stock that's taken off. So this is a prime candidate for me to be doing a bit of scaling out, I would think. It's potentially up 700% depending on where someone's gotten in from. This is not a stock I'd be on because I wouldn't have bought it at this. If someone would have asked about what do you think of this, I would have said, look, leave it alone. Not enough price action. It's thinly traded. There's nothing there. And then pop, blast off. So you never know. But it gave no signs that this was about to happen. So I wouldn't be on this one. Then by the time it did pop, it's like, well, how do you manage your risk? So held its initial gains quite well. Then it rallied again. Yeah, look, I'd be if I happen to have had this one somehow, I'd be holding it still. I'd be scaling out of it, locking some profit in, and keeping a core position and seeing what happens. So far, it's holding on to its gains quite well. It's volatile, but it is holding onto its gains. It's consolidating above the moving averages. Some of the stocks we've seen today, we've seen those spikes higher where they then completely give way and come all the way back. This is doing something quite different. It's holding gains, so that shows maybe there's some substance to this. Yeah, I'd be happy holding a core position, but I'd probably also be happy taking a bit off the table as well. Not often you get stocks that quickly put on 700%. It's I'd want to lock a little bit of that in.
Okay, thank you. The next one's from Alessandra. Hello, let's have a look at PPL.
Yeah, look, we're just going sideways at the moment.
I'm not sure if this is a correction, Jace, but yeah, I mean, it says RPL next. Sorry, Alexandra, but let's have a look. All right, we can have a look at both, but yeah, all right, go for it, because I don't think this one's going anywhere. Go for it.
It's look, it's we've got the makings of an emerging trend. So we've gone from below the averages to above. We've started to have a bit of a rally, and after that initial rally is now being consolidated with a sideways pattern. So it's a constructive price action. If I'd bought in on these early signs of momentum, I'd still be holding it. It's I'd still be holding it. It would be maybe it's in the money. It's trading the longest moving averages, slightly above it. I think it's got the potential to break higher from here. It's a possible entry point for this stock. If it breaks above, say, this week or last week's highs, maybe that's some signs of a momentum break. You can just put some rough trend lines on this to sort of something like that. You can kind of see that triangular shape to it. It's a compression. These compressions often lead to good moves. The key will be like, does it break to the top side? If it does, I'd be happy to consider an entry for that. And if I was holding it back down here when it initially crossed, as I say, I'd be happy holding it now. And then the other one, Rog, you were talking about?
No, it's RPL. So anyway, that's a good opportunity. RPL. Same viewer.
It's like there's an emerging trend there, and then it's given back quite a bit of that rally. I think I don't particularly like it how quickly it's giving back some of those recent gains. I would have rather this stock sort of pull back, but then quickly get a foothold and consolidate above the moving averages. Show that interest in buying at the dip. But instead, it's now quickly been sold below the moving averages. I think it's all just it's become a bit of a mess again, in that the upward momentum is not being sustained, but it's not a bearish setup either. It's kind of just a bit of a neutral one, where I think maybe we just got to watch this one and see how it trades in the coming weeks. If I'd bought some of this, depending where I bought it, I wouldn't have been a buyer down at these earlier stages because it was below the moving averages. Look, there's if someone's in from from below current levels to close to current levels, maybe they could give it a little bit longer. I just don't have a great deal of confidence in it. We don't have enough trending activity from it, and the trending activity that we did start to have has now been somewhat nullified by this quick move back, giving back the gains. So look, I think probably a bit of a neutral for me on this one, Rog. I'm certainly not a buyer. Maybe I could hold it a bit longer, but just know where my exit point is and work out how long I want to hold it for.
Okay, thank you. Any cup tips, Jace? Just have a break. Have any cup tips?
They haven't had a chance to look at the form. I've been looking at charts, stock charts all morning.
Oh,
So I've got to get to that after we finish filming.
yeah, sorry, I was texting that. All right, let's get on to Dennis's. Hello, RML.
Yeah, one of these low price stocks. Probably not one for me to buy, but if I had some, I'd keep holding it. At this point, it's we've got the rising moving averages, prices above the averages. Big spike up, it's come back down, but it has held at the moving averages and rebounded. So maybe there's some interest in buying the dip there. It's super speculative, isn't it? But sometimes these stocks pay off. Depending where we're in from. If we're down here in here, dollar at a cent and a half, I'd be doing some scaling out as we've discussed prior. But there's it has potential. I think it requires the ATR based stop, wide trailing stop back below the 100-day moving average if it's going to do well in the future and trend. I think it's going to be a volatile trend as it has been so far. It's going to need that wide stop to stay on board.
Mm-hmm. All right, thank you. Yuki, hello, WDS.
Just not doing much at the moment, and the oil price isn't doing much either. The oil price has been really difficult for the last over a year now, and so is Woodside. Not surprisingly, for me, it's not a buy at this point. It's really been range bound over the last, we've had this downward trending phase, and then we've rallied back above the averages. So maybe it's a start of a turnaround. But now we've gone into the consolidation phase of that initial rally. I probably need to see it do some more work. It needs to establish itself above the moving averages, which it hasn't really done so far. Like if we got price action where it just get just some more sideways, and then start to sort of round higher. It just doesn't look like we're quite there just yet. So if I was holding some if I happened to buy it as it was turning higher, I could continue holding it. But otherwise, I probably got a positive bias towards it simply because it's moved back across the averages. Maybe this is the turn, and it is getting ready for a larger advance. But there's nothing at the moment to say it's now's the time it needs to be bought, because we could get more chop and it could come back and retest the lows. Could do all sorts of things. So I'd probably just leave it, but watch it for now.
Okay, thank you. G'day, turntables. Let's have a look at BUS, please.
Is that BUS?
Yep, bus.
Not much to go off here, really. I'd just have to leave this one alone. It's above the averages, but it's above the averages in March, and turned lower. So it's it's a hard one too. You wait for the breakout, then where do you put your stop? It's like you wait for a breakout, and then you got to have a stop. It's going to be 42% stop. Or do you look, it's trading on its lows for the day, so it's not as if it's really picking up momentum now either. You buy it at current levels and you have a stop below the low from last month, and it's 22% of risk, but it's just a complete punt that it's going to pick up momentum before it without clipping the low from last month. I'd just leave it alone. It's if someone really likes it for some reason, well, it's hard. Like, you can really like some of these small resource stocks. You think they got something going, and then they just do nothing for years. So it's. I just don't see it in the price action at the moment. I'm not saying it can't happen, but I just can't really see the play just here and now.
All right, thank you. We'll do one last one here, please, Jace. PLS, please.
Yeah, well, it's 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 probably a bit more advanced than an emerging trend now. It's starting to develop into a trend. It's having a pullback, but the pullback so far being supported. Moving average have a bit of catching up to do, so maybe there's some more consolidation coming. But this is a stock that looks like it wants to continue moving higher. I'd be happy holding if I was on board this one, and depending on how this consolidation looks, maybe that sets up a buying opportunity. I'd probably hold off buying just at the moment because I'm thinking, where's my stop going to be? Look, it's 22% maybe. I guess it could be bought now, but bearing in mind that it also, even if it does continue to trend, there could be a multi-week consolidation in the meantime, just while the averages catch up. So possible entry point, or wait and see what consolidation comes if that's indeed what we get. But looks like, as I say, it looks like there's some more upside potential there.
All right, fantastic. Thanks, Jace. Peter, you're the last one before I drew that line in the sand in the comments there. We did do FFM though right at the start, so maybe just scroll back a little bit around the 20-minute mark, and we did do FFM there. Otherwise, I might finish off, Jace, on a general question here around adding capital. Just how much would you invest when adding to a new stock in your portfolio? Now, obviously, this is all going to be dependent on your capital that you've got and your goals and whatnot. So everything's general advice. But how would you split it up?
I prefer. I usually don't add capital to stocks. Sometimes I do. Generally, I don't. I tend to prefer to have many relatively small trades rather than to add to a winning position, because like we talk about how I talk about like scaling out of a position that might be up like 300% plus. And part of the reasoning for that is because as a stock rises, so initially it might start out as being 1.5% of my portfolio. And then if it goes up a few 100%, it might become 5%, 6%. Occasionally I've had a stock that's been up like a bit over 10% of my portfolio because it's gone up so much. So that's why I might scale out. So if I'm adding to a stock which is already up several 100%, I'm going to be increasing my weighting even more. So its weighting is naturally increasing because it's going up. If I keep adding to it, well, I may end up with a position that makes up 15 or 20% of my portfolio. I don't want that because it's then exposes a portfolio to greater volatility should that stock quickly come back. That said, if I were to add, I think in terms of a pyramid. So like, let's just sketch something in. So my initial position. So there's my initial position. I put the way I'd prefer to do it. There's many different ways to do things, and I've heard all different sort of strategies, and all sorts of things can work too. But there'd be my largest position would be at the beginning, and then if I was going to add, the next position would be a bit smaller, and then if I was to add again, the next position would be a bit smaller still. And the idea is I want to keep my average price down the lower half of the pyramid. If we turn this shape on its head, and like you imagine like this is someone's entry profile where they put on a starter position. It starts to go well. They get a bit confident. They go, yep, I'm going to have some more. And then they're really getting confident. Now the stock's up 100%. Go, yep, I'm really going to have a good go at this. Their average price ends up being, the average price probably ends up being up around here, whereas I prefer to keep my average price down around here. So when we do get stocks doing well, and we do get a pullback, my initial entry down here, my average price, I've got my average price down here somewhere, as opposed to having my average price up here somewhere, and this pullback quickly takes a great position into a loss. So that's why I'd aim for a profile as such. So I keep the average price, even if it rises, I keep it as low as I can. So these big pullbacks, when they do happen, are survivable, and I don't bring my average so high up that a relatively small pullback makes the whole profit, takes out my whole profit, takes me into loss, and I end up with a pretty unhappy sort of experience from the trade.
Okay, fantastic. And what happens? Just quickly, what about if you're just wanting to buy a new stock? How do you split your portfolio up across your stocks?
If I'm looking to
not add to a position, but rather just not add to a position, just buying a new stock.
Well, I just use a percentage of capital. In my motion trader portfolio of stocks, I use a percentage of capital. I've got a discretionary portfolio where there's more discretion in it. But it's just following the concept of many relatively small trades and spreading risk widely across a portfolio.
Yep. Okay, fantastic. So obviously it's just a matter of just deciding how much percentage you want to put to each stock, and how many stocks you want to own roughly with the capital that you have. Is that right?
Yeah, like if someone's got $20,000 of capital, there's going to be a limit on how many stocks they could have, because there's minimum sizes and trade sizes, and there's brokerage to be paid, and so I want to keep that percentage of brokerage fairly low. I don't want to have a big brokerage headwind I've got to trade through. So it's someone with $20,000 of capital might be limited to 10 to 20 stocks. Someone with $100,000 of capital might have 40, 50, 60 stocks. So it just gives more scope to have more trades, and I use a percentage for my personal motion trader portfolio, because it's a simple calculation. But someone might want to use fixed trade sizes. Might say, look, I've got $20,000. I'm going to put $1,500 into each stock and have a 15 stock portfolio or something like that. So everyone's got to look at their own situation, but it's more the principle of many relatively small trades. You've got to work out what relatively small is for you, and you've got to work out how much capital, how many stocks your capital can support and you're comfortable managing. So it's not like a one size fits all answer. It's there are a couple of moving parts, and you've got to move them. It's a sliding scale depending on your situation and what it is that you're after.
Yeah, no, I totally agree. But I think you've answered that perfectly. You do have to obviously create your own decisions around these things. We can only give you some general guidance. But I think that was sort of said perfectly. If you do want to know a little bit more about Jason's portfolio, obviously go check out his motion trader service at motiontrader.com.au. A lot of this stuff he talks about quite in his free stuff anyway. It's free things to be able to download, right? So it's some great valuable resources there. Not only that, but obviously with the paid service as well, right? So other than that, thanks, Jace, once again for another great week.
Yeah, that was good, Rog. Thanks everyone for joining us. It's been great having you here. And we'll come back next week. Have another go.
Exactly. And hopefully you have a great day in the markets. Not only that, if you are a punter, hopefully you have a great day on the Melbourne Cup today. The race that stops the nation. Hopefully we'll get off before then. But otherwise, don't forget to join us again next week. Don't forget to check out Selfwealth, link down below, or the Motion Trader link down below as well. And like and subscribe and comment as usual. And thank you for everyone that normally does it as well. We really appreciate it. I see that. Sometimes I'm not on top of it to like and love all the time, right? But I am there. I do see them, so I really appreciate it. Thanks, guys, and we'll see you all next week. Take care.